Steve, capital markets were pretty benign in the month of September with the S&P 500 up a couple of basis points and the Barclays Ag down a couple of basis points. How did that translate to the closed-end fund market?
Closed-end funds were pretty flat. The average fund was down about 14 basis points. The real story was muni closed-end funds that were down about 75 basis points, which was a fairly large loss relative to the gains that they've had recently. But really looking across the board, gains year to date have still been positive. You're looking at 10 to 15% returns across asset classes for closed-end funds.
Steve, I'm glad you brought up munis. We have talked in some previous videos about the strength in the muni market, and now you bring that up as one of the weakest sub-asset classes in September. And then I also noticed where in the first 2 weeks of October, munis are down about 5% on a price return basis. So can you walk us through what's happening in the muni market? Is this simply kind of reversion to the mean for an overbought asset class, or is there more to the story than that?
Sure. I mean, I think from the closed-end fund perspective, munis have been extraordinarily positive. Investors have generated very significant total returns, something in the neighborhood of 10% annualized returns on muni closed-end funds for the last 3 years. And so when things are going well, people tend to buy more of them.
Right.
And so that pushed a lot of closed-end funds to par or premiums. And we've said on a number of these videos that we think the market looks technically overbought. And what's happened recently is investors have they're more fearful of rising rates. The asset class has underperformed treasuries recently, and so you've had some losses, and investors have reacted to small losses, the small loss in September, by selling more aggressively. And that selling pressure has pushed closed-end funds down, as you said, about 5%. I think that's kind of the technical setup, but fundamentally, which I don't necessarily think the market's pricing in today, but it's a growing risk, is the fundamental picture is weakening for your average muni closed-end fund. Borrowing costs are up at about 150 basis points today. That's really up maybe on average about 100 basis points this year. And so your borrowing costs are rising while your income's declining. I mean, muni bonds are getting called away. When they reinvest, they're generating lower yields. And so the spread is narrowing, and that can put pressure on distribution rates in the future. And so fundamentally, the muni market's been weakening in the closed-end fund space. And technically, up until about September, it was priced to perfection. And so there was a mismatch and something had to give. And so part of this correction is just, you mentioned mean reversion, but it's reverting to more of a less overvalued position.
So Steve, in light of that, staying with munis for a moment, does this create opportunity, or, in your opinion, is there still repricing to come, and is the fundamental deterioration something that bears watching before you view this as, opportunity from your closed-end fund team?
Sure. I think from the fundamental standpoint, it's already happening. I mean, there's really no changing the situation that the yield curve is flattened and the earnings power is declining. Right. And so when you buy a closed-end fund, in my view, in the muni market today, you should expect a distribution cut at some point in the future. That could change. The yield, short-term rates could go back down and the earnings power could stay strong. But fundamentally, I think you should prepare for just a drumbeat of bad news from the fundamentals. From the technical side, a lot of closed-end funds are down 5%. Many funds are down 10%. I think there's more losses to come from many closed-end funds because the premiums that went to small discounts still aren't attractive enough to, basically pull in crossover buyers. And so I think there's air pockets beneath a lot of closed-end funds because a lot of people don't care about closed-end funds at 2 to 3% discounts. They have to drop another 4 or 5% to get people interested. And so you're probably going to see your average closed-end fund have more weakness. If that's the direction of the market, I think the new buyers don't step in until you see wider discounts. That said, the market, there's been a parallel shift, and so there are a lot of funds before the sell-off, maybe not a lot, but a handful of funds that looked pretty good, and now those funds have widened out in sympathy, really directly proportional to the average. And so a lot of funds that started off okay before the sell-off are now not only relatively attractive, but absolutely attractive. And so I think there's probably maybe 24 funds that look pretty good today. I wouldn't go out and buy a market cap weighted basket of closed-end funds, but I think if you do your research, there are some good opportunities today. It's going to be very volatile. When you have a 10% drop, you're probably going to see a couple points bouncing back either way. But it's important to keep in mind that the fundamentals are becoming more negative. It's not imminent that distributions will be cut, but we all know that yields are coming down, and borrowing costs are rising. And it's just simple math that distributions can be less if this continues. And so fundamentally, expect weakness, but that doesn't mean that you can't own closed-end funds. I mean, distributions have been cut for years, and discounts, and most market participants realize that distributions are going to be cut because yields have come down.
Right.
And so I don't think it's going to be a huge surprise now that the market's dropped where it was. But it's something to consider. Anytime you're buying a muni closed-end fund today, discount's important, but also analyze the fundamental picture.
Steve, thanks for your comments.
Thank you.